In this video, we're going to discuss the difference between Section 529 plans and Coverdell accounts. So both of these plans are tax advantage ways that you can save money for your child or your relative's educational expenses. In both cases, the contributions are not tax deductible, but the earnings grow tax free. However, there's some really important differences between these plans that you should understand. And first off, the Coverdell account can be used for elementary, secondary, higher education. So if your kid is going to be going to high school and you want to save money for a private high school or for college or for grade school, you can set up a Coverdell account. However, the Section 529 plans are only for college. They're only for higher education expenses. So you should just bear that in mind. Now with Coverdell accounts, there's a limit on the amount that the beneficiary, that's the student who is going to be receiving these funds ultimately, that person can only receive a maximum of $2,000 each year. No matter how many different people are contributing to that Coverdell account, that student cannot receive more than $2,000 in any given year. With the Section 529 plans, however, you don't have that $2,000 limit. And in fact, you can contribute $10,000, $20,000. The maximum investment will be set by the specific 529 plan. Each state will have its own 529 plan for public universities. There's even a 529 plan for private colleges with hundreds of colleges are part of it. And so you need to look at the plan in question and see what the maximum investment is. It might say, for example, $200,000 is the max investment in that specific 529 plan. In that case, that's the maximum investment. Now, there are some rules with Coverdell accounts about the contributions and distributions. So first off, all the contributions to a Coverdell account must be made before that beneficiary turns 18 years old. Once the beneficiary is 18, you can't contribute to the Coverdell account anymore. And the distributions from that Coverdell account for qualified education expenses must take place on or before that person's 30th birthday. With Section 529 plans, you don't have these time or age restrictions. Now, with Coverdell accounts, as your income is higher, so let's say your modified adjusted gross income, if it meets a certain threshold, as it gets so high, the amount that you can contribute begins to phase out. So if you make several $100,000 a year, you might not be able to contribute anything to your Coverdell account. You should look, the modified adjusted gross income, that could change on a year-to-year basis, so you should go to the IRS website and see what the threshold is. However, just understand, as your income grows higher, that could restrict your ability to contribute to the Coverdell account. With Section 529 plans, it really doesn't matter how wealthy you are, how much money you make. There are no income restrictions. In terms of the investments, because you remember each account, if we think about, for example, with the Section 529 plans, there's actually two types. One type, you prepay tuition, but the other type, you're actually having a savings account. So let's just think about the savings 529 plans for a moment, and let's contrast those with the Coverdell savings. So with the 529 savings, the investments, that the money that you put in is going to be invested in, those investments are going to be set by the program largely. Right now it's going to vary. Different states have different plans. You need to look at your state's plan. However, generally the investments are going to be set by the program. With the Coverdell account, you have a much broader range of potential investments. It's not some set thing that you have to go with. You have more flexibility in terms of how the money is invested, which is important because ultimately the benefit of a Section 529 savings plan or the Coverdell education savings account plan is that you're earning a return, and those earnings are going to grow tax-free. So then when the money is ultimately withdrawn years later by that beneficiary, they don't have to pay tax on any of the money that was earned. So it might be very important to you to have that increased flexibility of what kind of investments you can put